Interest rate hikes are a key tool used by central banks, such as the Federal Reserve in the US, to manage inflation. Here's a simplified explanation of how this process works. 1. Understanding inflation. Inflation is the rate at which the general level of prices for goods and services is rising. When inflation is high, the purchasing power of money decreases, meaning each dollar buys fewer goods and services. Central banks aim to keep inflation at a manageable level to ensure economic stability. 2. Role of interest rates. Interest rates are the cost of borrowing money. When a central bank raises interest rates, it becomes more expensive to borrow money. This affects various aspects of the economy, including consumer spending, business investments, and overall economic activity. 3. Impact on consumer spending. When interest rates increase, loans and credit cards become more costly. For consumers, this means higher monthly payments on mortgages, car loans, and credit card balances. As a result, people are likely to spend less money because they are paying more in interest. Reduced consumer spending can lead to slower economic growth, which helps to reduce inflation. 4. Impact on business investments. Higher interest rates also mean that businesses face higher costs for borrowing. When borrowing is more expensive, companies may delay or scale back investments in new projects, equipment, or expansion. This reduced investment can slow down economic growth and contribute to lowering inflationary pressures. 5. Effect on savings. As interest rates rise, people might also be encouraged to save more money because they receive better returns on savings accounts and other interest-bearing investments. Increased savings can reduce the amount of money circulating in the economy, which can further help in cooling down inflation. 6. Currency strengthening. Higher interest rates can attract foreign investors looking for better returns on their investments. This increased demand for a country's currency can lead to a stronger currency. A stronger currency makes imported goods cheaper, which can help reduce inflation by lowering the cost of imported products. 7. Managing inflation expectations. Central banks use interest rate hikes not just to manage current inflation but also to influence expectations about future inflation. If people believe that inflation will be controlled in the future, they may adjust their spending and pricing behavior accordingly. This can help stabilize inflation over time. 8. Balancing act. Central banks have to carefully balance interest rate hikes to avoid triggering a recession. While higher rates can help control inflation, if rates are raised too quickly or too much, it can slow down economic growth too much and potentially lead to a recession. In summary, by raising interest rates, central banks aim to reduce borrowing, slow down spending and investment, encourage saving, strengthen the currency, and manage inflation expectations. This complex interplay helps keep inflation in check and supports overall economic stability. When central banks raise interest rates, the impact is felt across various sectors of the economy. Here's how these rate hikes ripple through different areas and influence inflation. Consumer behavior. When borrowing costs increase due to higher interest rates, consumers face higher monthly payments on their loans and credit cards. This makes it more expensive to finance purchases, leading many people to cut back on discretionary spending. For instance, higher mortgage rates may result in fewer people buying homes or refinancing existing mortgages, while elevated auto loan rates could reduce car sales. This decrease in consumer spending helps reduce demand for goods and services, which can ease inflationary pressures. Business investments. Higher interest rates can have a significant impact on business investment decisions. Companies often rely on borrowing to finance expansion, purchase equipment, or fund new projects. As borrowing costs rise, businesses may postpone or scale back these investments. Reduced business investment can slow economic growth and contribute to lower inflation. However, this slowdown can also affect job creation and wage growth, potentially leading to broader economic implications. Savings and investment choices. With increased interest rates, saving money in banks and other financial institutions becomes more attractive because the returns on savings accounts, certificates of deposit, CDs, and other interest-bearing investments improve. Higher returns on savings encourage individuals to save more and spend less. This shift in behavior helps reduce the amount of money circulating in the economy, further helping to control inflation. Impact on currency value. Higher interest rates can attract foreign investors seeking better returns on their investments, leading to an increase in demand for the country's currency. A stronger currency makes imported goods and services cheaper, which can help to reduce inflation by lowering the cost of imports. Conversely, a stronger currency can make exports more expensive for foreign buyers, potentially affecting the balance of trade. Inflation expectations. Interest rate hikes also play a role in shaping inflation expectations. When central banks signal their intention to control inflation through higher rates, it influences how businesses and consumers anticipate future price changes. If people believe that inflation will be managed effectively, they may adjust their pricing and spending behavior accordingly. This can help stabilize inflation over time. Economic growth and employment. While higher interest rates are effective in controlling inflation, they can also slow down economic growth. Reduced consumer spending and business investment can lead to lower economic activity and potentially higher unemployment. Central banks must strike a delicate balance between curbing inflation and supporting economic growth and employment. Central banks' strategy. Central banks use interest rate adjustments as a tool to guide the economy towards their inflation targets while considering the overall economic conditions. Their goal is to maintain price stability and promote sustainable economic growth. By carefully managing interest rates, central banks aim to create a stable economic environment conducive to long-term prosperity. Understanding the impact of interest rate hikes is crucial, but it's also essential to recognize how central banks and policymakers make these decisions. Here's a deeper look at the process. Central banks' role. Central banks, such as the Federal Reserve in the United States, have the primary responsibility of managing monetary policy to ensure economic stability. Their main objectives typically include controlling inflation, maximizing employment, and moderating long-term interest rates. Central banks use tools like interest rate adjustments to influence economic conditions and achieve these goals. Economic indicators. Central banks rely on various economic indicators to make informed decisions about interest rates. Key indicators include the Consumer Price Index, CPI, for measuring inflation, the unemployment rate, gross domestic product, GDP, growth, and other economic data that reflect the health of the economy. By analyzing these indicators, central banks can determine whether inflation is under control and whether economic growth is sustainable. Interest rate decisions. When central banks decide to raise interest rates, they do so based on the prevailing economic conditions and their assessment of future economic trends. For instance, if inflation is rising above their target level, central banks may increase interest rates to cool down the economy and bring inflation back to a manageable level. Conversely, if the economy is slowing down, they might lower interest rates to stimulate growth and encourage borrowing and spending. Forward guidance. Central banks often use forward guidance as a communication tool to signal their future policy intentions to the public. By providing clear guidance on their likely actions regarding interest rates, central banks aim to shape market expectations and influence economic behavior. This can help businesses and consumers make more informed decisions and plan accordingly. Market reactions. Financial markets closely monitor central banks' actions and statements. Interest rate changes can impact various asset prices, including stocks, bonds, and currencies. For example, an increase in interest rates might lead to higher bond yields and lower stock prices, as borrowing costs rise and corporate profits may be affected. Currency markets can also react to interest rate changes, influencing exchange rates and international trade dynamics. Challenges and uncertainties. Central banks face challenges in predicting the precise effects of interest rate changes on the economy. Economic conditions can be unpredictable, and external factors, such as geopolitical events or global economic shifts, can influence outcomes. Central banks must continually assess and adjust their policies based on evolving economic conditions and new data. Policy adjustments. Interest rate adjustments are not a one-time event but part of an ongoing process of monetary policy. Central banks regularly review economic data and make incremental changes to interest rates as needed. Their goal is to ensure that monetary policy remains aligned with economic conditions and continues to support their policy objectives. Public perception. How the public perceives central banks' actions can also play a role in the effectiveness of monetary policy. If people believe that central banks are effectively managing inflation and supporting economic growth, it can enhance confidence in the economy and influence their financial decisions. Conversely, if there are concerns about policy effectiveness or transparency, it can impact market sentiment and economic behavior. Understanding the impact of interest rate hikes on inflation involves grasping the broader economic context in which these decisions are made. Here's a detailed look at how the process unfolds and its effects on the economy. Historical context. Interest rate adjustments have been a key tool for central banks throughout history to manage inflation and stabilize the economy. By looking at past instances of rate hikes, we can understand how these decisions have influenced economic cycles and inflation trends. For example, in the 1970s, the US Federal Reserve raised rates significantly to combat high inflation, which had substantial effects on the economy and financial markets. Transmission mechanism. The transmission mechanism of monetary policy refers to the process through which changes in interest rates affect the economy. When central banks raise interest rates, borrowing becomes more expensive for consumers and businesses. This can lead to reduced spending and investment, which in turn can help cool down an overheated economy and reduce inflationary pressures. Consumer behavior. Higher interest rates can impact consumer behavior in several ways. For example, higher mortgage rates can lead to a slowdown in the housing market, as higher borrowing costs make home loans less affordable. Similarly, higher rates on credit cards and personal loans can reduce consumer spending on goods and services. This reduction in consumer demand can help lower inflation. Business investment. Businesses often rely on borrowing to fund expansion and operational activities. When interest rates rise, the cost of financing increases, which can lead to reduced business investment. Companies may delay or scale back projects, which can have ripple effects throughout the economy. Lower business investment can also contribute to a slower rate of economic growth and help reduce inflationary pressures. Inflation expectations. Inflation expectations play a crucial role in determining the effectiveness of interest rate hikes. If people expect prices to rise in the future, they may act in ways that contribute to higher inflation, such as demanding higher wages or increasing prices for goods and services. By raising interest rates, central banks aim to signal their commitment to controlling inflation and influence expectations in a way that helps stabilize prices. Global influences. Global economic conditions can also impact the effectiveness of interest rate adjustments. For example, economic developments in major trading partners, fluctuations in commodity prices, and changes in global financial markets can affect domestic inflation and economic activity. Central banks need to consider these global factors when making decisions about interest rates. Policy coordination. Interest rate decisions are often part of a broader set of policy measures aimed at managing inflation and supporting economic stability. This can include fiscal policies, such as government spending and taxation, and regulatory measures. Coordinating monetary policy with other economic policies can enhance the effectiveness of interest rate adjustments and help achieve desired economic outcomes. Public communication. Effective communication by central banks is crucial for the success of monetary policy. Central banks often provide guidance on their policy intentions and the rationale behind their decisions. Clear and transparent communication can help manage market expectations and reduce uncertainty, making it easier for businesses and consumers to plan and make informed decisions. Long-term implications. The long-term implications of interest rate hikes can include changes in economic growth rates, shifts in investment patterns, and alterations in financial market dynamics. Understanding these long-term effects can provide valuable insights into how interest rate policies shape the economy over time and influence financial decisions. By considering these factors, you can better understand how interest rate hikes work to manage inflation and the broader economic effects of these policies. If you found this information valuable, don't forget to subscribe to our channel and like this video to stay updated on more financial insights and tips.